Hey, let's get this party started. Welcome everybody, world travelers, enthusiasts, free market lovers, music folks, adventurers. We are here not just for your safety. We are here to encourage you in the adventure and to walk alongside of you during that time. So we've got the world famous disclaimer up. Hey, travel at your own risk, Keith. We'll get into that in a second. And then you guys know the deal on this stuff. Everything you could possibly buy in your life is speculative, even bananas.
Beanie
So,
Babies. Beanie Babies.
and so anyway, yeah, we'll leave this disclaimer up just for a quick couple seconds. And thank you for joining us today. We are glad to be here with you. I'm coming at you from the basement of Gimbal Financial, and it's kind of like one of those old school basements that grandma might have had. I mean, this building's, I don't know if it's 100 years old or what, but Keith Tyner, Keith, where are you coming from? Where are you?
I am literally sitting on one of the most valuable pieces of real estate in New York City. It was one of the brightest spots of affluence back in the 1900s, and it's a piece of property that was owned by J.P. Morgan himself. I'm sitting on the steps here. Across the street is the New York Stock Exchange, and my friend here is just blowing a doobie right here while I'm getting some secondhand smoke, but it's all good. Um, this is just really an interesting part of financial history where I'm sitting here. Uh, it's not as interesting as it used to be because it's really whatever's going on in there is just really a kind of a computer place. They use the stock exchange for um, cocktail parties and things like that. It's not what it once was because most of what went on in that building is now done with the same technology that I'm broadcasting here from.
Yeah, and so okay, so you're at the JP Morgan building right across adjacent from Wall Street. And that's my favorite building in New York City. And it's my favorite because of the story. JP Morgan bought that.
Yeah,
It's a two-story building. And that it's a two-story building because JP Morgan wanted to show off his wealth. From what I understand of it, he wanted to say, hey, look, I don't have to have a high rise with people above me paying the rent. I
yeah,
can afford to have my own building. And last time
right.
I was there, well, no, I was there this winter, but I was there a couple years
Hey,
ago,
brother.
and they had turned that into
God bless you.
I think a Halloween store or something like that, where they rent it out to other people. So what is it right now? Can you tell what it's being used for now?
Well, it's 23 Wall Street, which if you want to remember that, it's the Michael Jordan Wall Street, and that was his number in case you weren't a sports fan. But it's retail space for lease, and there's some. It's closed. Like I said, this fellow was just here rolling joints and smoking them while I was sitting here, and so nothing's going on here. All the tourists are sitting there. They're behind since 9/11. They put a rail around it. They used to have a police officer with a machine gun here.
I think we've lost Keith there temporarily, but I'll tell you, the building is very interesting. If you ever get the chance to go check it out, there's pock marks on the side of it where a terrorist tried to blow up Wall Street and in a wagon cart. And if you get to go inside of it, the art that's etched into the limestone is just it's stunningly beautiful. It kind of tells the history and the story of America and growth, from pioneers to Indians, and it's a beautifully ornate building. But hey, I'll go ahead and get us started and take a walk through the stock market with you. This is the S&P 500 index, the largest of 500 companies in the United States. Most of these are global companies. They'll have a headquarters here, but they're doing business all over the world. And one of the things that we would like to see, and we'd like to see that the market keep going on this rally, And then eventually, boy, if it could get back to these February highs and take out those highs, we think that could just be a very positive thing. But nevertheless, the S&P 500 has had a really good last couple of days, just building momentum steadily. And that's what we like to see. Boy, we haven't seen that type of just steady growth for a long time, and I'm encouraged by it. Keith, you're back.
Yeah, it's crazy the technology that I can join you from where I'm sitting. And what I was saying is there were $50,000 suits that the traders would wear, and they're nobody. I don't even think anybody in New York City wears suits. I've seen a few suits, but it's not even a thing anymore. Just that's a cultural observation more than the economic observation.
I tend to think since 9/11 that New York has gotten a little softer, and I don't mean soft in a bad way. I mean a little kinder, and can't help but just think that after 9/11, people started to think through the priorities of life and how they treat each other. And so I think some areas of New York are just, really great. And you're in one of them. I know we read about subway muggings and all kinds of craziness that goes on in the news, and all of that's true. But when I've been in New York, I've just found New Yorkers to be incredibly kind-hearted people, helpful, and and they don't mind seeing a guy come from Indiana.
Yeah, I don't. People are anticipating somebody coming out of the stock exchange, like it looks like Secret Service or somebody like that staying around. So I don't know what's going on. I thought I'd give you a glimpse of something interesting went on. But last night there's a place just north of where I am called a vertical park. Have you heard of that?
No, I don't know of it.
I mean, if you got time while I'm talking, if you can pull it up a picture on the Google me to show them. But we were standing there by the vertical park and just kind of doing our own thing, talking about it, and and while we were doing that, a New Yorker just came over and told us, really, if you want a picture of that, you need to move over to this space over here. We unsolicited came up, and there are some very cordial and kind people here. So
I'm not as quick on the draw of the vertical park.
Okay, sorry.
We'll just have to.
You guys Google it. Don't.
Yeah, you guys Google.
Yeah.
Well, so now tell us what you're doing there in the city. Why are you even there?
Well, the honest story is I think it's not a safe place for a man to travel by himself. And a friend of mine was coming here, and since I can work remotely, he was coming by himself, and I just said, "Hey, man, why don't I travel with you?" That's the real reason. So I just came. So whatever he needed to do, he wasn't flying solo here, and I'll be back Sunday.
That sounds pretty good. So this week I had the privilege of attending a conference here in Indy at the High Alpha Studios, and High Alpha is a really it's a pillar to our community. It's a pillar to Indiana and the Midwest. They make a lot of investments in companies and startups and helping them grow. And the organization that I was there and part of is a group called Citizen 7. And Citizen 7 is a group of people that get together to just encourage like-mindedness in Indianapolis, try and encourage optimism, try and encourage startup and growth, and having fun with friends while doing it. And so it just made me start to think, like, it doesn't take much to get some real positive stuff going. And it just takes a couple like-minded people to invest in others. And I was just really encouraged. One of the guys was talking about, what does Indianapolis have that we could lean into as a world-class city? I mean, Indianapolis, if you start to pull people there, Keith, they'd think, oh, now where are you from? I think there's some corn there. I think there's some basketball that goes on. But beyond that, what is it that our city is world class in, and what can we lean into? And one of the things that our speaker said that we could lean into is, we are the racing capital of the world, and that's coming up, where you have glamour, you have speed, you have innovation, you have technology. You have excitement, and the Indianapolis 500 is just around the corner. And what a great brand, what a great story for us to lean into. Like, while you're in New York, if you were to say, have you ever heard of the Indianapolis 500? I'm guessing some people are going to say, yeah, that is something I know about. They may not know anything about Indiana. They may have flown over Indiana, but they've probably heard of the Indianapolis 500. And so that's something I took away from this week, and just getting out and meeting with people. It was a inspiring thing. Keith, do you want to talk about the stock markets? I started to go into the S&P 500, where we are a little bit. Is there anything you had on your mind that you wanted to share or address?
Sure. I think one of the observations I had about New York City when I was walking down here earlier today is I think, as kind of crazy as it sounds, I think somebody who lives in Indianapolis or St. Louis or not New York City, or let's try to see what's going on out here. Somebody was excited about somebody. I can't tell. But anyway, I think if you lived here, you wouldn't be very open-minded. I think you don't have exposure to anything but this. So you're walking down the streets, everything. There's a lot of groupthink here, and so I would think Indianapolis and places like that have much greater opportunity for open thought, creativity than a place like this, which sounds weird because you think that's where it's at, but it's just a ton of groupthink that goes on here. And so that's a cool thing about Indianapolis. The markets. I just was going through, we spend a lot of time watching Mark Minervini and people like him as part of our research. And I was looking at some Minervini thoughts today that he's offered out in the last few days. And he said, even though there's a number of large breakouts in the market because of what's happened after that action where stocks start moving upward, as an investor, that he and his associates are mostly in cash. They're barely invested because the market's just had a lot of sellers. And then he said the reason of that is simply just respecting risk and maintaining patience and composure. And I think that's really what we've done. If we put our toe in the water for trades for you all to try to get you invested, we're not willing to let your capital deteriorate in this market. And one of the things that, even though the indices are going up, it hasn't broadened out. So the indices are heavily weighted, which means that some stocks will move the index greater than another stock will. And so if you don't have those heavily weighted stocks in your portfolio, you're not seeing the appreciation that's going on in the index. So anyway, that's why they're suggesting caution as you move forward. And I think I noticed this week as I was watching things that there was a little bit more spreading out, that some other stocks were starting to gain some traction.
Yeah, and that's something that we saw in 2020 and in 2021, is there was a group of leading stocks that really propped up the indices, that made a large portion of the indices themselves. And those were the FANG stocks at the time: Facebook, Apple, Amazon, Netflix, Google. Those types of stocks really led the way and boosted up the indices because they were such a large portion of them. And the breadth of the indices, some of the smaller or medium-sized companies, those really haven't started to turn around quite yet like the big names have. So we're seeing some of that again, but we've got to have leaders, and we're getting ready to jump into earnings season again. And that's always a great time when companies are reporting their numbers, and those numbers are compared to the analyst estimates. So these analysts come out and they say, we think Apple's going to earn a dollar a share by their fiscal year end, which their fiscal year end is in September. It's kind of interesting. And so we think they're going to earn a dollar a share. And then Apple comes in and announces, hey, we earned, I'm making this up, $1.20. Well, that's great. That's great for shareholders. If Apple comes in and says, hey, we made 90 cents, that's a miss. And that's not great for shareholders. So we're in a season right now of not only earnings being announced, but we're in a season of expectations. Did those earnings meet the expectations of the Wall Street analyst? Or maybe they meet them, but they miss a revenue, or they miss a forecast that says, hey, going forward, we see things slowing down, or we see we're going to be affected by these headwinds, commodity prices, currency exchanges. And so now's a really interesting time for stocks, for companies as they're reporting their earnings. And this is what it's all about. This type of expectation is what drives markets.
Right. And our friend Patrick, one of his mantras during earnings season is that it's not the earnings, it's the response to the earnings. It's not the news, it's the response to the news. And so so you and I and everybody else that invests might have an opinion about a news event and how that should affect the stock. But I think something that we've mentioned a number of times is the market itself is a leading indicator of the future. And so when the news comes out, it's already generally priced in to a stock or the overall market. And so the big move that happens for those things is probably the unexpected part of that news. And that's where it gets dangerous. If the unexpected thing is way beyond what you thought and you don't change your opinion, you could get rolled over like a steamroller or by a steamroller.
Yeah, having a contingency plan is something Keith and I have been talking about lately. What is the contingency plan on the downside? What is the contingency plan on the upside? And one of the ways that we can see how the investors are voting is when we look down here on the bottom right-hand side of this chart. You can see I'm circling with my cursor. This is the volume bar. And so all of these vertical bars that spike up here, this tells us the convictions of shareholders. Are they buying more shares? Are they selling? And then when we tend to go above this red horizontal line, that's a 50-day average of the amount of trades and buys and sells. When we get above that, that's conviction. That tells us that people are either selling or they're buying, and they're doing it with conviction. And so not only do we look at price up here, the price has been pretty good on the S&P above the 200-day. It's great to see. The volume tells the story on, hey, how jazzed are people, or how afraid are people of the markets? And so, Keith, I'm going to go ahead. You might not be able to see this, but I'm going to go ahead and switch gears to look at the VIX and talk about that for a minute. This is a volatility index. It measures fear and greed, and does a pretty nice job of it. And one of the things that you can see from this chart is it is low. It's lower than where we've been in a while. It wasn't too long ago we were up around this high mark of 3081, and today we're trending down near this 1706 bottom that we had in January. And so this has been a good sign for investors to see that things have been calming down. And my hypothesis on that is there's been a little bit more clarity on where interest rates might be going for the future. And, if the interest rate hikes slow down, or we were even to get a couple of pauses, that could be a very good thing for the markets.
Yeah, the volatility spiked up there, Doug, on that screen from the banking crisis. And one of the terms I saw over the weekend when I was doing some research was a bank walk. I don't know if I showed that idea to you or not this week. Have you heard that term, a bank walk?
No, I have not. I've heard a bank run. Tell me about the walk.
Yeah, the idea of a bank walk is I was managing some money for a family member in a bank account, and I got the statement from the bank account, and let's say it was $50,000, and the bank gave me a interest for that period of time of $8 on $50,000. Okay, and that was almost a 0% interest is what I quickly did in my head. So I went online and found a bank literally across I-69, maybe an eighth of a mile from where the one bank was. So I walked into the bank and got the $50,000 in a form of a physical check, walked into my car, drove across the interstate and walked into the other bank and deposited it for a 5% CD. And so from getting like $8 in interest on that 50,000, now it's going to get 2,500 a year on that same, that was going to pay me maybe $100 a year. And so what that does is the idea of people, by the banking crisis happening, I think it's brought more attention to people about their bank accounts. Like mostly they were looking at their, most people were watching their financial statements as the market was correcting or having a bear market last year and seeing those things. And then with the Silicon Valley Bank imploding, people started asking questions about their bank accounts and started paying closer attention. So if a bank move is doing that and people are more aware, they can literally take millions and millions of dollars out of those banks. They can do it with their phone. They can do it by walking into the bank. But as those assets walk out of those banks, it's not what happened in the 1930s, kind of a bank run. It's a slow disruption of the balance sheet of those banks. And it's going to create a lot. I think the ripple effect of that banking crisis last month will still have some effect in our economy as we go forward, but it's not something that I think you need to be like chewing on your fingernails about.
We had a little bit of a walk last year when we left LPL Financial. Money market rates really weren't paying a whole lot, and we had limited options, and we have some better options when we've walked over to Trust Fidelity for safekeeping and asset holding, and their money market rates pay a little better. And it's, again, these are things that aren't necessarily going to change your life, but if we can make some incremental improvements over time, they tend to stack up and add better value. So anything else going on from your lens, Keith?
Well, maybe we can talk more about the disruptive nature of a bank walk next time. It takes a little bit more time, but there are some other economic observations I had. Jeremy Siegel is I don't know if he's a curmudgeon. He's an economist out here in the East Coast, and he was talking about the bank stress test that the Federal Reserve had was set up to test banks' stability up to a 2% Fed funds rate.
Okay.
And he said, this is another example of the Federal Reserve's failure, because now we're almost at a 5% Fed funds rate.
Right.
And so they didn't really, the regulators who were watching out for us, didn't even occur to them that a more normalized Fed funds rate could disrupt more banks. And so the question I had, the rhetorical questions that I had when I was reading what Siegel said was, who raised rates above 2% and who kept them below that? And so the Federal Reserve was the one that created this thing as though they were able to control it. And then Brian Westbury, who we've mentioned a number of times on the show, I saw one of his comments this week. If central bankers, which the Federal Reserve is the US central banker, they're all alluding to they didn't cause the problem, which the problem at least in my opinion, is that there was too much money for free for too long, which created a printing press kind of a scenario. If the Federal Reserve and other central banks claim they didn't cause the problem, then how can they fix the problem that essentially they did cause? So just kind of thought provoking when you think about it.
And there's so much out there on inflation right now and rising prices of this or that. I recently read an article about the rising prices of stamps. And I just want to encourage you guys, as you're looking through these articles, don't just take it for what it is. I mean, inflation is going to double the cost of stuff every 24 years or so anyway. And so just look for ways to stay positive. There's a bunch of news. We're in an election cycle again. There's a bunch of news out there meant to grab your attention, unlock some fears for you so you have to deal with them. And so I just want to encourage you guys to stay focused on things you know to be true. look for positivity. What's the saying? I've never met a wealthy pessimist. It's not like you got to be overly optimistic or Pollyannish all the time, but the world is great. We live in the United States. There's great stuff happening here every day. Great stuff happening with the youth in America. It's not just all this stuff you might see in your favorite flavor of news. There's really positive stuff happening out there, and you just got to get out there and see it. So, Keith, that's all I had from my angle. Is there anything else that you wanted to cover today?
Yeah, I got a couple other things, but along the lines of that quote, Doug, one of the quotes that has always stuck in my head, I don't have the quote exactly, but I think it was a variation of something Winston Churchill said. But essentially, it is if you're a pessimist and right and an optimist and wrong, you get to the same destination. Just one of you had a better ride. And so you're not, if all the pessimism you can have in your mind is correct and everything goes to the most pessimistic place, that really the pessimist isn't going to be able to protect himself any more than the optimist is. So any way you can feed yourself with wisdom and positive thoughts is really healthy in both good times and bad times. But conceptually, what one of the indicators I saw, now this will sound pessimistic, but I'm not really trying to be pessimistic, is according to the publication Bespoke, the Conference Board's index of leading indicators year over year were down 6.5% when they reported that in February. And essentially that's not ever happened before since 1960. And anytime there's been a 5% drop in that, there's been a recession within the next 6 months. And I don't think that's really new information for our viewers, because I think we've been talking about the inverted yield curve, the just all the indicators that are suggesting that we're going to go through a recession. The first indicator that indicates a recession is coming is a down stock market. And so last year's stock market probably foreshadowed that we'll probably go through a recession this year. And all a recession means is that the economy contracts somewhat. And that's not unpredictable, I don't think, at this point in time. It doesn't mean you need to go hide in the basement like you're doing today, Doug, but it just simply means there'll be a slowdown with some unknown consequences. And again, through those slowdowns, just keeping optimistic and being realistic and paying attention. If you've got questions or concerns, I think we're readily available to talk you through our views and our thoughts and help you make shifts if you need to.
Great time to be innovative too. I mean, your best investment is always in yourself. And so recession or whatever, maybe a personal recession that you go through or a personal depression that you go through, great time to reinvent yourself. And Keith mentioned the inverted yield curve, and several of you know what that is, but basically it's where the short-term rates are higher than the long-term rates. Kind of goofy, but that does happen. And right now we're in one of those seasons.
What that says, Doug, is that when the short-term rates are higher than the longer-term rates, what that does is it's the economy or the markets foreshadowing that they believe a slowdown in economy will push interest rates lower in the future. And if you're wanting to own CDs and things, it's a sucker bet to go with the 1-year CD versus the 3-year CD, because whenever the yield curve does that, it's telling you that most likely 3 years from now, that 3-year interest rate is going to be substantially lower than where it is today. So if you're thinking I'm going to get that special at my bank with a 8-month CD that's a lot higher than the 3-year CD, you might get a higher interest rate for 3 months, but you may be, or 8 months, but you may be shocked at what that actual reinvestment yield is. So if you got questions on possibilities of that, I'm sure we're happy to help you with that also.
Yeah, hit us up on that. Hey, everybody, have a great weekend. Keith, I know you're going to have more fun in New York today. I'm really jealous. Boy, there's just so many things to do that are free in New York City. That's one of my favorite parts.
I didn't tell you the travel at your own risk story, so I better tell that to our friends before I roll. We're leaving Indianapolis yesterday morning, and I don't know how they put the throttle, if they push it down or pull it back. I don't know what the pilots do. They had that thing cranking, man. We're halfway down the runway. I don't know how fast we're going. And the next thing you know, he chalks it up. We're at least halfway down the runway. And all the travels I've had, never had that happen. My emotions didn't do anything. I'm like, huh, that was interesting. And so we curl back to the gate, and they keep us in there, telling us that, hey, we're just gonna have some things checked out. And I'm looking out the window and I see the baggage cart coming on. I go, he's not telling us what going. Yeah, he's telling it's, and they're taking the baggage off. I go, well, we're going to jump on another plane, so we're not going to get to New York when we thought. So we get on the next plane that had been sitting all night, and when they turned it on, there was a light on the dash, and so
Alternator
we make
went
it.
out.
Yeah, I don't. And so and the people were unbelievably kind. On the passengers were, and so they're turning the engine off and on. I'm like, I don't know anything mechanical, but that's the kind of stuff I would do to try to get the light to go off. And I'm like, I'm okay with whenever my final day is. So if the best they can do is turn the engine off and on, I'm like, I guess that'll work. And then finally that didn't work, and they flew a plane in from Louisville, Kentucky that had been working. So that gave us a green light. But it was there were two contingency plans that Delta Airlines had in place. They had a spare plane in the Indianapolis airport and a plane that could get to us in a timely manner to reload the passengers and get us there. So what you were talking about earlier about us having contingency plans for our clients that we really love and respect. That's just the way that I think wisdom is expressed, even if it's kind of disappointing to you in the short term that you didn't get to the city when you got there. So that's the story on travel at your own risk, man. It's good hanging out with y'all today.
Everybody have a good weekend. We'll see you next week. Bye-bye.